I pulled the phone to my lap, but still kept the football game on, somehow hoping it would all blow over. As I began to review my list of contacts to determine whom to call, my mind went back to a meeting I had with Lehman's chairman and CEO Richard Fuld only 3 months earlier. I had not seen Fuld for years, and we both agreed it might be a good time to get reacquainted. And so, late one June afternoon, I headed to Fuld's office in Midtown Manhattan to try to get a better understanding of what was truly going on at the firm he had led for the previous 14 years. A day earlier, the firm had reported a second quarter loss of $2.8 billion and said it was raising $6 billion in new capital. Lehman was certainly not in good shape, but it seemed poised to survive. Fuld did most of the talking. He seemed to be testing out a new approach to explaining why his firm was going to thrive in the years ahead. I sat respectfully as he droned on, talking about Lehman's global franchise and all the ways it could make money beyond the financing of real estate. Fuld is a tough guy. But as I sat back and listened to him pontificate on the merits of the firm he had shaped, he seemed out of touch, as though he were not fully entrenched in the new reality of the financial world, a reality in which every firm had become suspect. Toward the end of our meeting, I asked Fuld why he went ahead with a $22 billion deal to finance and buy the giant real estate investment trust Archstone, a deal that compounded its holdings of real estate. It was a deal Lehman could have exited. Whereas doing so would have hurt the firm's reputation, it would have saved it billions in potential losses in what was already an uncertain real estate market. Exiting the Archstone deal would have also saved Lehman from endless conjecture on just how much money it was losing from the deal, conjecture that contributed to a lack of confidence in the firm's solvency. Fuld seemed surprised at the question. "It was a good deal," he told me. "We still think it's a good deal." I really thought the question might prompt a bit of self-reflection or even self-criticism. But that was Dick Fuld. He believed. 2 days after our meeting, Fuld would fire his longtime number 2, Joe Gregory, and his chief financial officer, Aaron Callan. A few quick calls had me now somewhat up to speed with what was developing. Lehman had been having conversations with both Bank of America and Barclays about an acquisition. But as the weekend came to a close, there was no deal. The key reason was that the U.S. government was making it clear it would not step in to take on any of Lehman's bad assets. Without a government assist, would-be buyers were leery. What had seemed improbable on Friday and inconceivable during my meeting with Fuld only a few months earlier was now likely. Lehman Brothers was about to go bankrupt. It was only the start of the longest night of my career. For weeks prior to that Sunday evening, I had also been following the startling decline of another company that was far less visible than Lehman Brothers, but far more important to the health of the world's financial system. American International Group, AIG, was the world's largest insurance company. It was built by a man named Maurice Greenberg into the greatest single powerhouse the insurance industry had ever known. In many countries around the world, Greenberg had written the laws that would govern the sale and use of insurance. AIG was, for many years, among the most valuable financial companies in the country. Its market value was routinely above $150 billion. But in 2006, the then 81-year-old Greenberg had been forced from the company after New York's Attorney General Eliot Spitzer accused him of wrongdoing. AIG would never be the same. Many of the risks the company took on during Greenberg's reign were risks that he alone may have fully understood. Still, there were few who had any true concern about its financial health. As a reporter, you tend to follow your sources. While the world was chasing the rapid decline of Lehman, I found myself far more interested in what was going on at AIG. That was because a handful of people I have known for years were involved with the company's travails. AIG had suffered from a series of quarterly losses. Its stock had sunk dramatically. And in the weeks leading up to that Sunday night, It had lost $50 billion in market value. Still, while the idea that Lehman Brothers could go bankrupt had been contemplated by the many investors and trading counterparties that relied on it, few, if any, of those same constituencies would ever have thought about such a fate befalling the massive AIG.